What if I tell you Microstrategy just survived a catastrophic 75% stock crash and is currently sitting on billions in unrealized losses, yet it is mathematically safer today than it was at its peak? Welcome back to Smart Stock Sam, where we cut through the noise and follow the numbers. Today, we're diving deep into whether Microstrategy is actually headed for bankruptcy or if the fear-mongering headlines have got it completely wrong. Stick around because what we're about to uncover will completely change how you see this company's survival strategy. Here's what most investors are missing. Yes, the 75% drawdown from the highs is brutal. There's no denying the mark-to-market pain is real. But when you actually analyze the balance sheet, something fascinating emerges. Solvency, safe. Liquidity, safe. The company has optimized its entire structure for one thing: duration. They can outlast this storm longer than almost anyone else in the market. However, there is a caution flag we need to address, and it's not about bankruptcy. It's about shareholder value, and we'll get to that critical distinction in just a moment. Let's put the damage in perspective. The stock plummeted from a high of $455 down to $110. Bitcoin itself retraced over 40%, leaving Microstrategy staring at unrealized losses between $3 billion and $4.5 billion. Their blended cost basis sits at $76,000 per Bitcoin, significantly higher than current spot prices. On the surface, this looks catastrophic, and when you add in weak labor data and AI capital expenditure concerns, the narrative writes itself. But is the story really that simple? When investors see losses of this magnitude, one fear dominates every conversation: forced liquidation. Could Microstrategy be forced to sell their Bitcoin holdings at a massive loss? This is where understanding the capital structure becomes absolutely critical. In a traditional margin loan scenario, if Bitcoin dropped to $30,000 or $40,000, the lender would trigger an automated forced sale. You'd have no choice. Your position gets liquidated whether you like it or not. But here's where Microstrategy is different. Their debt structure has zero loan-to-value triggers. None. Their convertible notes and preferred instruments are completely uncollateralized. Management holds over 713,000 Bitcoin outright. There is no liquidation mechanism that can force them to sell against their will. This isn't a margin call waiting to happen. This is strategic architecture. So if they can't be forced to sell, the next logical question is, how long can they actually survive? Here's where the numbers get really interesting. Microstrategy is sitting on $8.2 billion in convertible debt. But check this out. The blended coupon rate on that debt is just 0.42%, less than 0.5%, and it gets better. They've staggered their maturity ladder so intelligently that there are no critical debt repayments until 2027. They've essentially built themselves a massive runway of time. No immediate pressure, no ticking time bomb, just pure temporal optionality. But having a long runway means nothing if you run out of fuel before you reach your destination. So let's talk about the liquidity shield. Microstrategy maintains $2.25 billion in USD cash reserves. To put that in context, that represents over 30 months of interest coverage. Think about that. Even in a worst-case scenario, they can cover their interest payments for 2.5 years without touching a single Bitcoin. But here's the stat that really drives it home. At current prices, they have a 59-year runway to cover their Bitcoin dividends. 59 years. They've built an absolute fortress that insulates their treasury from short-term price volatility. The storm can rage outside, but inside, they're protected. And they didn't stop there. They added another layer to this fortress, a type of capital that practically functions as equity. Microstrategy uses what they call stretch, strike, and stride instruments. These perpetual preferreds are a strategic masterstroke. Why? Because they have no maturity date. None. They require no principal repayment. Ever. This allows the company to keep accumulating Bitcoin even while sitting on unrealized losses. They've effectively neutralized what's known as cliff risk, that sudden drop-off where debt comes due and you're forced into desperate measures. It doesn't exist in their structure. So after examining the triggers, the debt, and the cash position, What's the final verdict on those bankruptcy rumors? The answer is a definitive no. This is not a liquidation story. This is a time arbitrage story. With staggered maturities pushing out to 2027 and beyond, combined with massive cash reserves, Microstrategy has the ultimate luxury: time. They can wait. They can endure. They can ride out the volatility. The solvency metrics are rock solid. But while those numbers look incredible, there's one hidden metric that changes the entire equation for common shareholders. And that's what we need to examine next. We've established that the external defense is secure. The company isn't going bankrupt. But now we have to shift our focus to the internal metrics. Because if the balance sheet is safe from creditors, who is actually at risk here? The answer? Common equity holders. This is where the story gets more complex, and it all centers on one crucial metric. For the past 2 years, the goal was crystal clear: grow Bitcoin per share, accumulate more Bitcoin per outstanding share, and shareholder value grows with it. Simple, elegant, effective. But something has changed. We've entered what I call the dilution phase. Management has shifted their strategy, now prioritizing absolute collateral growth over per-share accretion. What does that mean in plain English? The equity base is expanding faster than they can acquire Bitcoin. The primary yardstick for shareholder value, Bitcoin per share, is actually declining. This is the real risk investors need to understand. And the reason they're forced down this dilutive path is because a key funding window has slammed shut. Here's the trap. Microstrategy cannot use their non-dilutive preferred funding mechanisms if the stock is trading below its par value of $100. When they're stuck in this trap zone, the full weight of Bitcoin accumulation falls on the common stock, which is highly dilutive at current valuation levels. Every new share issued to buy more Bitcoin dilutes existing shareholders. The pie gets bigger, but your slice gets smaller. This is the cost of capital trap, and it's the real challenge facing Microstrategy right now. But even with this constraint in place, Microstrategy remains in a league of its own when it comes to market positioning. While competitors have been exiting their digital asset strategies left and right, Microstrategy stands alone as the only liquid institutional-scale player in this space. They maintain a 1.5 times correlation to Bitcoin, making them the primary vehicle for institutions seeking reliable, repeat buyer exposure despite the volatility. They're not just a player in this market, they are the market for institutional Bitcoin exposure. So if they're the only horse in this race, where do we draw the line for a tactical entry point? The charts reveal a major psychological and technical floor at $100. And here's where it gets interesting. We've seen whale alerts in the options market. Institutional players have been aggressively writing puts at the $100 strike for February 2026. What does that tell us? These sophisticated players are essentially defining the floor for us. They're putting their capital where their conviction is, betting that $100 holds. Once that floor is established, what does the roadmap back to growth actually look like? The path forward has 3 distinct stages. First, we need preferred par recovery. The stock needs to climb back above $100 to reopen that non-dilutive funding window we talked about earlier. Once that happens, the dilution pressure on common shareholders starts to ease. Second, we watch for the key performance indicator inflection point, where Bitcoin per share stops declining and starts growing again. That's when the shareholder value proposition reignites. And third, the 2027 refinancing event will allow them to convert debt into equity without any cash outflow, further strengthening the balance sheet and extending their runway even more. So, what is all this actually worth if the plan succeeds? Here's where the asymmetric opportunity comes into focus. If you believe in the $1 million Bitcoin thesis, and that's a big if, but it's the thesis Microstrategy is built on, the implied share price target sits between $2,500 and $2,600. Yes, the volatility is extreme. Yes, the path forward has risks, but the asymmetric upside potential is undeniable. For the institutional investor looking at the digital capital transition, this isn't a speculative gamble. This is the premier, most liquid bet available on that transformation. So here's what it all comes down to. The bankruptcy narrative? Completely wrong. The solvency metrics are secure. The liquidation fears? unfounded. The structure protects against forced selling. But the shareholder dilution concern? That's real. And it's the trade-off investors need to understand. Microstrategy has built a fortress designed to survive the storm. But surviving and thriving are two different things. The question isn't whether they'll make it through. The question is what condition they'll be in when they emerge on the other side, and what that means for your position as a shareholder. A fair reminder, like always, this video is for educational and informational purposes only and should not be construed as financial advice. The analysis presented represents opinion and research, not recommendations to buy or sell any security. Microstrategy stock and Bitcoin are highly volatile assets that carry substantial risk. Past performance does not guarantee future results. Always consult with a qualified financial advisor before making any investment decisions, and never invest more than you can afford to lose. If you found this deep dive valuable, smash that like button and subscribe to Smart Stock Sam for more authentic analysis that cuts through the headlines and follows the numbers. Drop a comment below. Do you think the $100 floor holds? Are you bullish or bearish on MicroStrategy's strategy? I read every comment, and I'd love to hear your perspective. Until next time, stay smart, stay informed, and always do your own research.